The $37 trillion debt time bomb. The U.S. national debt grows by $1 trillion every 100 days. At this pace, we'll hit $55 trillion by 2029. To put that in perspective, the entire U.S. economy produces about $27 trillion in GDP annually. We're adding debt faster than we're growing the economy that's supposed to support it. Imagine a balloon expanding far beyond the room it's in. Eventually, it's going to burst. Debt-to-GDP ratios above 120% historically precede financial crises. Right now, we're at 122% and climbing. Japan crossed this threshold in the 1990s and still hasn't recovered. Their stock market peaked in 1989 and remains 30% below that high. Their economy has stagnated for 3 decades. The difference? Japan's debt is mostly held domestically. Ours? Nearly a third is owned by foreign investors who could demand higher yields or walk away. Each 1% increase in interest rates now adds $370 billion to annual interest payments, more than the entire U.S. defense budget. Last year, interest on the debt surpassed spending on Medicare. Within 3 years, it will overtake Social Security as the federal government's largest expense. This isn't some distant future, it's happening now. In 2013, when U.S. debt first crossed 100% of GDP, the 10-year Treasury yield was 1.9%. Today it's 4.7%, with nearly double the debt load. Higher rates plus more debt equals exponentially larger interest costs. The Congressional Budget Office projects interest payments will hit $1.4 trillion annually by 2033. That's money we can't spend on infrastructure, education, or defense. The Treasury Department now spends more on interest than on veterans' benefits, transportation, and education combined. Every dollar going to bondholders is a dollar not going to roads, schools, or research. This isn't abstract economics. It directly impacts what the government can do for its citizens. Foreign buyers are losing their appetite for our debt. China's holdings of U.S. treasuries have dropped 40% from their peak. Japan, our largest creditor, has been reducing exposure too. The Fed is no longer buying bonds. They're letting $60 billion mature each month without replacement. That leaves domestic banks and individual investors to absorb the flood of new issuance. The government needs to refinance $7.6 trillion in maturing debt this year alone. That's like paying off your mortgage by taking out a new one at higher rates. Each refinancing locks in more expensive borrowing costs for decades. The average interest rate on outstanding debt has already jumped from 1.6% to 3.2% in just 3 years. State and local governments face the same squeeze. California pays 4.1% on its 10-year bonds today versus 1.2% in 2020. Illinois recently paid 5.3%, nearly double what it cost them 3 years ago. These higher borrowing costs mean less money for police, firefighters, and teachers. Corporate America isn't immune either. Companies refinanced debt at record low rates during the pandemic. Now they face a wall of maturities coming due. High-yield bond defaults have already doubled from last year's levels. Moody's predicts the default rate will hit 5% by early 2025. The last time debt levels were this high relative to GDP was World War II. Back then, the solution was rapid economic growth and financial repression, keeping rates artificially low. Today, with an aging population and slowing productivity growth, those options aren't available. The Fed can't keep rates low while inflation runs hot. So what happens next? How do we navigate a future where debt outpaces growth and interest costs crowd out everything else?